Hello and welcome to this weekly market recap for the week ending Friday, October 17th, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and it is a pleasure to come back to you again this week with stock market action for the week. It was kind of a strange week because if you recall, last Friday had a huge selling episode going into Friday afternoon. And I really expected that we would see some follow through to the downside this week. And instead, we had a gap up on Monday morning, and for the most part, finished on Friday about where we started on Monday. We did see a little bit of strength throughout the week, but really not a whole lot. It was really just that gap up on Monday, and then more treading water than anything else. We did see some strength in small caps middle part of the week, and then the small caps gave it all back by the end of the week, and they too finished just slightly above where they had gapped up. But we'll go over all those numbers in just a minute. I do want to let everyone know that next week does start the worst week historically for the S&P 500. It doesn't mean that we have a huge sell-off every year. I don't want anyone to get that impression, but historically there is no other week since 1950 consecutive week period that has performed as poorly as the one that starts at the close on October 21st, which is next Tuesday. So at least keep that in mind next week. Historically, not a good one. The good news is once that week ends, as of the close on October 27th, normally that is when we start the most bullish period of the year. We have a very, very strong 10-day period that runs from the close on October 7th through the close on November 6th. And then we also, that October 27th close starts a very lengthy bullish period that doesn't end until January 18th. And that is when the stock market makes some of its biggest gains of the year. So we'll see if that plays out again this year. I can tell you, though, that about, I think of the last 74 years, this period from October 27th close to January 18th, has finished higher 63 of the last 74 years. That's a pretty good percentage. Obviously, it doesn't happen every year, but the odds are pretty heavily stacked in the Bulls' favor. But we do need to get through this upcoming bearish week first. All right, let's take a look at what happened in the action this past week. So bear with me one second. All right. Transports gaining more than 4% on the week. So it was nice to see the transportation group do better. Had a big earnings report come out from JB Hunt Transport Services, JBHT. Had a huge gap up there. Some really big moves to the upside in the trucking group. You'll see that on a chart list that I'll show you in just a little bit. But JBHT definitely lit a fire under the trucking group, and that in turn led to some nice outperformance in transports. NASDAQ 100, Russell 2000, both up just under 2.5%. S&P 400 mid-cap up just under 2%. Then we had the S&P 500 gaining 1.7%, and the Dow Jones 1.56% higher. A couple things to point out here. Number one, we did see small caps outperform the S&P 500 again over the course of last week. It was an up and down week, as I mentioned just a little bit ago. But overall, we did see a little bit better performance on small caps than we did the S&P. So I think that continues to bode well for small caps. And the NASDAQ 100 performing better than any of the other major indices other than the transports. And that bodes well because of the growth orientation of the NASDAQ 100. The fact that most of these stocks are very, very growth oriented. And to see that group outperform tells us that the rebound as money comes back into the market this past week, we are seeing it rotate into growth, which is a good thing. As far as the individual sectors go for the course of the last week, real estate actually led last week, but you can see consumer discretionary, technology, and communication services in the top 5 spots. Those are the 3 most aggressive groups. So it was encouraging to see strength there. Not so encouraging, though, to see financials really not participate in the rally, gaining just 0.04%. All 11 sectors were green last week. But again, financials not really performing well. I have a seasonality chart that I'll show you a little bit later. That's a little strange for financials to lag like that. And again, I'll show you that in just a little while. S&P 500 had that big drop last Friday. That's where you can see that big red filled candle. And then we had a gap up on Monday and pretty much just sideways the rest of the week. Not really, market unable to make up its mind which way to go. I'm a little concerned that this could be an A move to the downside last Friday. And then this week is the B with a little bit of a rebound. Next week being bearish. Is that going to put in a C, where we move lower and take out that low that we saw from last Friday? I don't know the answer to that. We'll have to watch to see, but that is definitely a possibility that we should all be thinking about. I'm going to pull up that 10-minute 5-day chart because I want you to see the S&P 500. Here was the gap up. And if I do it on a 10-day chart, this will help you see a little bit better. Here was that Friday, the big move down a week ago Friday. And then here was the gap up on Monday. And look at where we finished. I mean, we opened at about 66.20 and we closed at just over 66.60. So even though we were up 1.7% on the S&P 500, 1% of it was the opening gap on Monday. So really not a whole lot of movement to the upside. And if we look at the NASDAQ 100, you'll see here was the gap up right around 24,600 on Monday, finished at 24,800. So again, less than 1% of the move was actually made during the week. Most of the move was made at the opening gap. And then we can do the same thing with the Russell 2000, the IWM. Much more volatility here, but you can see this was the Friday move. Here was the gap up. This is where we finished. So again, pretty much the same as the other two indices, except we had a lot of strength early in the week, all the way through Wednesday's open. And then we saw a lot of weakness over the last 2 or 3 days, mostly as a result of regional banks getting hit pretty hard. Jamie Dimon, one of my least favorite people. He has usually nothing good to say, always has something bearish to say, tries to be a stock market prognosticator. He's not a very good one, but he likes to stir the pot from time to time. He was talking about some of the credit issues that he believes are out there. Of course, 3 months ago, he also, I don't remember exactly what he was talking about, but just about every quarter, he's talking about something that bothers him in the market. And usually the market ends up shrugging it off and going higher. That's what we did last quarter. I suspect that's what we're going to do this quarter. But in the meantime, at least for the period of a couple of days, and we'll have to see what happens this week, we did see some of the selling kick in, and especially in that regional banking area. But overall, we did finish higher on the IWM. We gapped up on Monday. We did finish higher from there, even though it was a little bit more volatile. Moving on to the transports, I wanted to show you the transport chart because we are simply going sideways, so really not a whole lot to look at here. But one thing that was different about transports is that we not only gapped up on Monday, but we had buying throughout much of the week on the transports, and we actually cleared the high from the Friday a week ago. We had the big sell-off, that big red filled candle. We actually went back up above it. So trying to get back through the moving averages. Not really able to do that just yet, but it was an encouraging week for transports. All right, technology. Now, some folks are saying, well, why aren't you more bearish? There has been some rotation in the market, money rotating more, a little bit more toward value and so forth. Well, didn't really see that this week. I mean, I actually saw more rotation toward growth on the bounce back. That's one of the things you look for. Because when the growth areas start getting hit, what you normally see is growth going down with the market. And then when the market bounces back, a lot of times it'll print a final high and growth doesn't go with it. So the money just continues to rotate, even though the S&P breaks to a new high. A lot of times it's led by defensive or more value-oriented stocks. And that normally is not a good thing. So I just wanted to show you here on the XLK. This is a weekly a weekly chart going back 5 years. And if you notice here on this move up in the XLK, you can see the XLK also moving up relative to the S&P 500. So we're seeing relative strength in one of the most growth-oriented areas of the market. Well, not one of the most growth-oriented areas of the market, technology. And so this is not what we normally see before a major correction or bear market. Normally what we would see, if you go back and you look at 2022, when we had a actual bear market leading up to it, we were moving up here in technology. Technology was moving up relative to the S&P, but look what happened as we went into the final month in December and then into January. So when the S&P set its final high, technology was already starting to sell off, and then we started seeing breakdowns in the indices. That's really what triggers a much deeper period of selling. And we'll get those warning signs, then we start seeing confirmation with price action to the downside on the major indices. We take out key support levels, and then things start to accelerate to the downside. But and that's what happened in 2022. More recently, I mean, even here, we were trying to break out in the XLK, couldn't do it. But if you recall, the S&P 500 did make that breakout in February of 2025, earlier this year. And so what you see is the technology group really lagging. And even from the high that we saw back in the summer of 2024, you can see from there all the way up through the beginning of 2025, as we went up, we put in new highs on both technology and the S&P 500. Technology on a relative basis was really struggling. And then we saw a breakdown in the major indices, and we ended up having a bear market. Again, this is not what we're looking at right now. Hopefully you can see the difference here. Here you've got technology continuing to move up, and it's moving up relative to the S&P. Wall Street is not moving out of technology. Wall Street is moving into technology. Not what you normally are going to see right before a big sell-off. Another chart I thought would be interesting to show you is the IWF, which is large cap growth. This is the ETF that tracks the Russell 1000 growth index. So these are large cap growth stocks. And here again, you can see the growth stocks moving up. Look at growth relative to the S&P 500. It's up near its high back in February of 2025, earlier this year, before we started the bear market. Again, very much the IWF was very much like technology. It was moving up, couldn't quite break out. You can see on a relative basis starting to roll over. And then the market started to struggle, and that triggered a bear market. Same thing happened back at the end of 2021. You can see the IWF trying to get through, could not get through. So as the S&P 500 breaks to a new high, the IWF does not. And look at the relative strength rolling over. So again, money rotating away from growth at the top. That's what you need to be worried about. So I just don't see that happening now. So I feel pretty good about the market going into the end of the year. I'm just a little bit nervous short term, partly because of what I talked about over the last week, where the volatility index was going up with the S&P 500. That tells us that it's not going to handle bad news very well. And so when news broke about the regional banks, we did see a lot of selling, especially in the smaller stocks, because that's where you're going to find most of those small and mid-sized regional banks going to be more heavily impacting the IWM, which is where we saw that selling on Wednesday, Thursday, and into Friday. Moving on, wanted to just update any of those of you maybe that are new to earningsbeats.com. Let you know you can go over to earningsbeats.com, check us out. That's my home. You can go in, you can sign up for a free no-cost 30-day trial by clicking that button, completely free for 30 days. And then we'll notify you after the 30 days or right before the 30 days are up to let you know that your trial is about to expire. We usually give you a really attractive annual membership if that's what you want. Or, of course, you could cancel after the 30 days. But if you don't kick the tires, you won't know. If you are brand new to Earnings Beats and you just want to learn more about us and how we approach the market, feel free to watch our shows. We do plenty of these shows. I write articles over at Stock Charts. Also, if you come down, you scroll down, you'll find a free newsletter. This is no credit card required. Name, email address, all it takes. You can subscribe there. This is a newsletter, comes out Mondays and Wednesdays. And if you're worried that, oh, I don't have time It's literally one chart and two paragraphs. If you spend more than 3 to 5 minutes on it, I don't know what you're doing, because it shouldn't take that long to just take a look at the chart that we're featuring. Try to make these charts very educational. So if you're looking to learn more about technical analysis, learn more about earnings season, relative strength, all the things we like to talk about, this is the perfect opportunity to do so. And while thinking about it, if you like our video, if you like watching these videos, hit that like button, show us some love. It helps us with the YouTube algorithm. Also, subscribe to our channel. That really helps us. And it'll help you as well, because sometimes we do have we have a live stream events from time to time. And if you're subscribed and you have your notifications turned on, you will be notified the moment we start one of those free shows. So make sure that you are not only hitting that like button, but also subscribe to our channel. We really appreciate that. One other thing, if you do come on board right here with that no cost trial and become a paid member free for 30 days, we are having our model ETF draft on Monday after the close. We do keep a model portfolio along with 2 stock portfolios, model and aggressive. Excuse me. That's our stock portfolios. But our model portfolio, model ETF portfolio, excuse me, one second. As of Friday, October 17th, so as of today, we ended the quarter. So starting on Monday evening, we'll let everyone know when we're going to start up our next quarter, and we're going to give you all of our selections, our ETF selections. But we closed out the quarter gaining 5.96%. We did slightly outperform the S&P 500. I'm not sure how many quarters in a row that is now. I don't remember if it's just the second one or third one. We kind of changed our strategy with these with the model ETF portfolio in particular, and focused on sector ETFs as opposed to just regular ETFs. So we're only using the sector ETFs like the XLK, XLY, XLC, and so forth and so on, but we're changing the weighting. So if we believe technology is going to outperform, we want to have a little bit more of a weighting in that area. So something at least to kind of keep in mind. But come join us and start that trial and be in the event on Monday evening, where we go over our model ETF portfolio for the next quarter. All right. One chart list that I like to use, just to kind of summarize the market and what was working, what's not working. This is our industry group relative strength chart list. And I go in here and I like to set it on a week. So at the beginning of the week, or today at the end of the week, just kind of get a sense of what actually outperformed throughout the week. So some days we have some groups lead, other days another group or handful of groups will lead. But what led for the balancer throughout the course of the week? And that's what this chart list tells us. So we have 104 different industry groups. And you can see from here the industrial and office REITs. Remember, I said real estate was the best performing group for the week. Well, here's one of the industry groups within the real estate sector, gaining 7.5% more than the S&P 500. This is not absolute gain. This is a relative gain. So the S&P 500 went up 1.7%. Industrial and office REITs outperformed by 7.5%. So you can go down and kind of take a list or look at the list of what was working this week, what was not. Trucking, as I mentioned earlier, I said JB Hunt Transports outperformed after reporting very nice quarterly results. And I said I would show you a chart list later, kind of highlighting the strength in trucking. Well, this is it. So trucking was fourth this past week out of the 104 groups. And I'll show you an absolute chart on it in just a minute. Gold mining and mining continue to be very, very strong groups, outperforming the S&P 500 once again. A couple of other key areas I always like to point out: internet stocks gaining almost 3% more than the S&P 500. Then you come down here, semiconductors, always good to see semiconductors doing well. And then we can flip this and take a look at what didn't work this past week, you can see a lot of financials. So at the beginning of every industry group on here, I have a number for a particular sector, and then I have the ETF itself for that sector. So you can look and see how many different financial industry groups were littering the bottom of this industry group relative strength chart list. So probably of the 12 worst performers, it looks like half of them were financials. So not a good week for the financials. And I'll show you a chart on that in just a second in terms of seasonality, which this kind of goes against what we typically see in seasonality. And then there was one particular group. Well, let me go ahead and show you this seasonality chart first, and I'll go through some of the industry groups that I thought looked interesting from that list that we just went over. Here's financials relative to the S&P 500 over the last 13 years. So that's since this secular bull market was confirmed back in April of 2013. And notice financials relative to the S&P 500 improve as we go throughout these last few months of the year. Start to pick up in September, get even better in October, really strong in November. These are the average outperformance, average relative gains on the XLF. 0.2% is the average outperformance in September over the last 13 years. That jumps to 0.9% average outperformance in October. And then November is when it peaks, 2.2% relative outperformance. So this is why I was a little, when you look at financials and 6 of the industry groups among the bottom 12, out of all the industry groups, it's a little bit surprising when we consider historically that we are now in the sweet spot for financial. So this is going to be an interesting area of the market to watch going into next week to see, do we start to see if the market does sell off, do we see some of the selling in some key areas maybe rotate back over to financials? Maybe we get a little bit of relative outperformance there. All right, looking at some of the industry groups that were on the list. One was commercial vehicles. If I go back over here, that was on the percentage gainers. It's right here, commercial vehicles and trucks. So they outperformed by about 2.5%, but I wanted to look at them because they did make another breakout. So there was that week ago Friday selling, went down below the 20-day moving average. But this past week, a lot of money rotated back into commercial vehicles. So I would say that's one of the areas that I would maybe focus on in terms of short-term trading. I think any kind of a pullback is probably going to give you an opportunity to trade some of the better stocks within that group. So we always talk about leading stocks within leading industry groups. That's really what you want to look for within the commercial vehicles and trucks area. Internet, I pointed out internet. When I looked at the chart, it looks like it's starting to regain some strength. And after a move to the upside, this could be the right side of a cup starting to form. So I just wanted to point that out. Moving on to the trucking group. So here is the chart. So trucks had a great week last week because of JB Hunt Transport Services. But, I mean, still, we got a lot of problems here. Since downtrending all the way through April, even though the markets had this huge rally off the April low, trucking still is really not that much higher than what it was back in April. So, yeah, it was a good week, but a good week doesn't mean it's a great area to trade. I think we still got a lot of work to do to strengthen, the technical conditions here in the trucking area. Semiconductors continue to move up. This was a strong group last week on a relative basis, but we haven't made a breakout. So we had the big sell-off last Friday, saw a big gap up on Monday, pulled back Tuesday, and then kind of just went sideways into the end of the week. Which way do we break? Do we break back out to a new high, or do we maybe potentially do this kind of ABC correction? Semiconductors are one of the most influential industry groups in the market. So it's really important to watch this group at all times. When they're trending higher, it's generally a great sign for the market. It means that the market is in a risk-on environment. Folks are willing to take all of that added risk that semiconductors give. And so that's usually a good thing. You want investors to have that risk on mentality. When semiconductors are underperforming and going in the opposite direction, that's when we have a risk off, more of a risk off environment. So which way do we break here? I think that's going to be a story of next week as well. All right, this was option expiration week. So the October monthly options expired today, Friday. When we did our Max Payne session back on Tuesday evening with our members, we gave two stocks. We gave warnings on two stocks in particular. These were stocks that had made big moves up and they had a ton of in the money call premium. And what we always say with these is they provide us, the Max Payne provides us a directional clue. And what we were saying with Oklo is that this is one that we thought had a very good chance of moving lower, because by moving lower, it saves payouts by market makers. These big Wall Street firms don't have to pay out as much in option premium. So it's always good to be aware of stocks that you own that have a lot of in the money call premium, net in the money call premium. Oklo was one of those. The stock opened on Wednesday. I'm going to shorten this just so we can get a better view of it here. Let's just look at the last 3 months. So here was Oklo opening and moving above 190. It actually moved above 190 on Wednesday morning. And this green line is where market makers would pay out the least amount of money. Now, we don't look for it to go all the way down there. Many times, I mean, that would be a huge drop, 190 down to 130 in 2 or 3 days. Not practical. However, every single dollar that Oklo went down from 190 toward 130 saves market makers a fortune. And so just check this out. From over 190, the stock was in the 150s. Literally the next day, it was in the 150s. And Friday kind of held up okay, but traded down into the 150s from above 190. The other stock that we gave was RGTI, which is Rigetti. And going back using the same 3-month chart, here you can look, this was Wednesday's open. We were up at near 58. The Max Payne, actually, let me pull it up on this other chart because this will have the actual Max Payne level. And then we'll do 3 months again. So check this out. So we were at 58 on Wednesday morning. Tuesday evening, told members Max Payne was 43. Do you know that on Friday, the low was 43.65 from 58? And do you know how much money we had projected that market makers would save if Rigetti were to go back to 43? It was almost $100 million. That's how much the payouts on options came down by Rigetti dropping $15 in 2 days. I'm telling you, it's legalized thievery, what market makers do. And if you're not aware of this stuff, we do this every month for our members, by the way. We have our Max Payne event. If you're a paying member, if you sign up for a 30-day free trial, you'll get next month's as part of your free trial. But anyway, these two stocks, I mean, you could have paid for annual membership had you decided to short these two stocks based on the size of the losses these two encountered. We saw probably about a, 10% drop in Oklo, and RGTI from 58 to 43. That was $15. That was probably about 26, 27% in 2 days. Pretty significant drop. Anyway, that's about all I have for this week. So we'll see what happens next week. It's going to be very interesting because I do think the market is a little skittish here. We have the worst week of the year historically coming up. But on the heels of that, we do have the strongest period. So it's kind of an interesting week. Well, actually, it'll be the week after because it'll be on Monday, the 27th. But the 27th at the close not only ends the worst week of the year historically, but it begins the best 10-day period of the year. So it's pretty interesting date that you always want to keep in mind. I never forget it, October 27th at the close. Anyway, that's all I got for you this week. Have a great weekend. Enjoy yourself, and I'll be back next week. Happy trading.